In our cover story, it may be an indicator of the housing recovery's strength. President Obama says it's time to start the process that may ultimately replace mortgage finance giants Fannie Mae and Freddie Mac with a bigger private sector entity to backstop the U.S. mortgage market. President Obama flew to Phoenix, Arizona, a housing market that has seen home prices jump 20% in the last year. With that as the backdrop, the president said it's time to reassess Fannie Mae and Freddie Mac.
For too long, these companies were allowed to make huge profits buying mortgages, knowing that if their bets went bad, taxpayers would be left holding the bag.
What do you do with Freddie and Fannie? I mean, you don't want the government in the mortgage business.
During the housing crisis, Fannie and Freddie received $188 billion in taxpayer bailout money. Now, a bipartisan Senate bill introduced in June would create the Federal Mortgage Insurance Corporation to back mortgages and charge lenders for guarantees, similar to the FDIC's guarantee of bank deposits, preventing bank runs.
It will require the banks to be more diligent in looking at their loans. Now, that may sound like it's going to be tougher to get a loan. Not necessarily, because we've already fallen into those criteria in the past year or two, and the housing market is doing exceptionally well.
I think the banks have learned their lesson.
Morningstar analyst Robert Johnson says home prices nationwide are up between 7 and 12% over a year ago, but still 25% below where they were when the housing bubble burst. Now, getting back to where housing was before is in sight.
That would imply something in the 2-year range, and 2 to 3 probably is a fair range.
The president also called upon lenders to keep wide access to the 30-year fixed mortgage, the key for many first-time homebuyers. For the record, the Fannie and Freddie bailout is being repaid, and a lot of it is due to rising home prices. So far, the mortgage giants have returned $132 billion in dividends to the U.S. Treasury.